Hello and welcome to the video. My name is Brandon and today I'll be talking about stocks. Just what type of stocks, you may ask? No, I'm not here to talk about soup stocks. This isn't a cooking channel. And no, I'm not here to talk about those annoying photos that you try to add to your school project but you can't. And if you're a Call of Duty fan, no, I'm not talking about that attachment that you add to the end of your gun that helps you aim better. I'm here to talk about one of the greatest wealth generators available to us as human beings, and that is investing in publicly traded companies. So dating back to the 16 and 1700s, stocks, or the equity markets, have been the primary generator of wealth. I mean, the stock market is responsible for trillions and trillions and trillions of dollars generated over the years. And we look around in our daily lives and we are surrounded by companies that are thriving and growing and producing all sorts of profits. And we can invest in these companies and partake in the growth thanks to stocks and the stock market. But before I talk about what a stock is, how we go about buying stocks, and my quick little screening process for choosing stocks, I'm gonna give you a little analogy about what it's like to be an equity investor. And the analogy is that investing in stocks is like flying on a plane. So I live in Vancouver, and let's assume that I wanted to go to LA. I could hop in my car and I could drive. I could probably take the train, but I think the most optimal route would be to fly there. I think we can all agree on that. But sometimes when we fly, we experience turbulence. And sometimes it's minor, and sometimes it's a little more serious, and at times, it can be pretty intense. But a plane is built to handle that turbulence. That's what's expected when you fly. It's part of the process. You may run into some turbulence. And although it can be frightening at times, you think logically and 99.9% of the time, I'm gonna make it to my destination just fine. Now, this logic is almost directly applicable to investing in the equity markets. When we invest in stocks, it will not be a smooth ride. We will hit turbulence. And we have to expect that we're gonna see bad days, bad months, and bad years. But statistically, we know that this is our most effective and most efficient route at achieving our financial goals. And for some people that are just deathly afraid of flying, they can't handle the turbulence, well, in that case, maybe consider another option. Maybe get in your car and go on a road trip. Same applies to investing. If you can't handle the ups and downs of the markets, if you can't bear to see your portfolio drop 10, 20, 30, 40%, then maybe being an equity investor just isn't for you. So, what is a stock? Well, a stock represents a tiny portion of a company. It's as simple as that. You look at companies like Apple, Google, Coca-Cola, and they have millions of shares outstanding, each representing a fraction of the company. And as investors, if we have the money available, we can go out and buy some for our portfolios. But let's first look at how a company goes public, because not all companies are publicly traded companies. We can't just go around and buy stock of any company we see. For example, your uncle may own a pizza shop. That's a company, but you can't buy shares of it. That's what we would call a private company or a private corporation, owned solely by your uncle. And there are a lot of big companies that are still privately owned. Take, for example, Uber. Now let's assume that as time goes on, your uncle's pizza company starts doing very well. It's growing, he's selling lots of pizzas, maybe he's franchising out and there's stores popping up everywhere. Well, at some point, he can make the decision to offer part of his company to the public. So investors like you and I can invest or buy equity in his company. And this is where we get the term equities. Stocks are often referred to as equities. Now this would be called an IPO, an initial public offering. And any stock that trades on a stock exchange has gone through this. And it's important to note that for any given company, there's a limited number of shares floating around the economy. And when we want to buy a stock, we're buying it off of another investor. A common misconception that I hear, especially with the younger generation, is that when you go buy a share of Apple, Apple doesn't get your money. You're not buying a share from Apple. These shares are already outstanding. It's another investor that you're buying it off of. Unless you're buying it directly from an IPO, which rarely happens. It's primarily institutions and maybe more sophisticated investors that get into this. A lot of younger retail investors like ourselves, we seldomly will purchase directly from an IPO. And then a year from now or 10 years from now, when you sell it, you're selling it to another investor, all completely independent of the company Apple. So what determines the price of a stock? Well, when you apply basic supply and demand principles, you have a limited number of stocks. If the company does well and the demand for those stocks increase, that'll drive up the price. Or conversely, something negative happens with the company. For example, you're Chipotle and you start poisoning all your customers. You don't cook the meat properly, you give a bunch of people E. coli. When the prospects don't look so good for a company, the demand for the shares fall and the price will fall with it. So every day, for whatever reason, you're gonna see these fluctuations in the share price. It's gonna move up and down, and that's just the nature of the beast. But let's talk about the basics. How do we go about buying stocks? Because we obviously don't go to our local stock store at the mall. I'll explain very, very briefly. When we want to invest in stocks, we have to choose a broker or a brokerage. And this can be something like a bank, an independent investment firm, or nowadays you can do it online through an online broker. And this is where you'll host your investment account at. Once you've chosen your broker, you then have to open up an investment account within the brokerage. So this would be something like an RRSP or a TFSA. And I'll talk much more about this in other videos, but basically, an investment account is very similar to a bank account in that you can deposit cash in, you can transfer funds in, and once the funds are in the account, you can then go ahead and buy stocks, bonds, mutual funds, ETFs, pretty much whatever you want within that investment account. But the stocks themselves are traded on a stock exchange. Like if you wanted to go buy some fruit, you'd go to the fruit market. Or if you wanted to go buy some fish, you'd go down to the docks and you'd go to the fish market. Or if you wanted to go buy a pair of Yeezys, you'd order a fake pair from China. Just kidding. You'd go to a shoe exchange. Well, stocks are no different, and every day millions and millions of shares exchange hands between investors via the stock market or via a stock exchange. And the common ones are the New York Stock Exchange, and this is where the big American equities would trade. The NASDAQ, and this is where the big technology companies trade, so companies like Microsoft. And then in Canada here, we have the TSX, or the Toronto Stock Exchange, for the Canadian equities. So how do we make money with stocks? Because this part's important, and there's two ways. The first is very simple. It's called capital gains. So we purchase a stock today for $100, a year goes by and it's now worth $200, we can go ahead and sell that stock and we've earned ourselves a capital gain, minus of course any commission costs. But the second way that we make money with stocks is with what's called a dividend. And a dividend is a portion of a company's profits returned to the shareholders. So let's take Royal Bank for example. Let's assume that in this year they made $10 billion in profits. Banks make a lot of money. They can take a portion of that and pay a dividend to the shareholders. And let's assume they pay a $2 dividend. That means for every share that you own, you would receive a $2 income stream throughout the year. And this would be completely independent of how the share price reacts. So the stock could trade flat all year and you'd still receive this $2 dividend simply as an incentive for holding the stock. And dividends are paid quarterly, so you'd receive 50 cents and then 50 cents and then 50 cents and then 50 cents. And if you own multiple shares, you'd receive multiple dividends. So a very, very underrated part of investing. Now, two important points to note about dividends. Not all companies pay dividends. And a lot of the big blue chip companies, they tend to, but not all of them. Especially younger growth-oriented companies. Take, for example, Tesla. I mean, first off, this company's not making a whole bunch of profits. And even the profits that they do make, they'll likely want to reinvest that back into their company. Maybe go build some more cars or another factory or that type of thing. On the other hand, companies in more established industries, like the financials or the utility sector, these companies tend to pay nicer dividends. Now, the second point to build off of that is that dividends are not mandatory. So if a company does offer a dividend, that's completely by choice. And they have every right to reduce it or even cut back and cancel it altogether. And this doesn't happen all too often, but at times it's in the company's best interest to do so. Nevertheless, dividends are an extremely important part of investing, and for anyone that's looking to get into stocks, they should absolutely factor this in when they're making their decisions. But to end this video off, I'm gonna give you some guidelines that I use when I'm choosing or selecting stocks. If you are looking to get into stocks, I would absolutely recommend to stick to the large cap or the blue chip companies. And these are the multi-billion-dollar companies that we see around us every day. And it's not to say that these companies are immune or invulnerable. We can think of some prime examples of companies that once dominated the market and are no longer around today, or nowhere near where they used to be. But in general, these big blue chip stocks are more secure than, of course, the smaller cap, the no-name, the penny stocks. And if you're looking to go invest in penny stocks, go find yourself another video. Remember, this is our retirement savings that we're talking about here. And I don't want to invest in a company that may not be around in 2 years. But a good thing about investing in big blue chip companies is that they have very good, credible track records that we can look back on. We can go back 5, 10, even 50, 100 years and see whether the company's profitable, whether they're growing their revenues, or how they're deploying their cash flow. And as well, we can assess the management of the companies. Look at the CEOs, the board of directors, the direction of the company. On top of that, you also get third-party analyst coverage on these big companies. For example, companies like Globe and Mail or Morningstar or Credit Suisse. I mean, these companies are devoted to breaking down the company's balance sheets and taking in all the factors and giving recommendations as to whether it's a good buy or a good sell. And you don't get this with the smaller companies. Secondly, pick companies that will be around in 10 to 20 years. And Warren Buffett says it best. If the stock market were to close tomorrow, would you be happy holding the companies that you own? And again, remember, you're investing in these companies. So it goes without saying, you want to pick companies that 10, 20 years from now will still be dominating in their industry. And on to my final point, and this is the fun one. Invest in companies that you like. I mean, if you drink 4 Cokes a day, go invest in Coke. Or if you're big into video games, go do some research on a video game company and pick one that you like. And maybe next time when you spend $80 on some downloadable content, you won't feel as bad. It's much more engaging to invest in companies that you're passionate about, ones that are incorporated in your daily life. So that concludes my video on stocks, and I really tried to narrow it down to what I feel is important and relevant, especially to a beginner investor. But if you have any questions or comments, leave them in the comment section below and I'll happily get to them. And if you enjoyed this video, give it a thumbs up and subscribe for more content. And I thank you for watching, and I'll see you in the next video.